Hey everyone, I am back with another dividend stock investing video. It's been a while. Thank you for your patience. I want to cover a stock today that is trading at a PE just under 3. This is a company that has fallen recently in share price, much like most of the stock market, and it's trading at a deep discount PE ratio. A lot of people in the community have been asking me to cover this stock, and so I'm going to review Viatris, ticker VTRS, in this video today. But more than that, I want to share with all of you why I'm not buying this stock, despite the fact that I already have a position in Viatris, despite the fact that it is a solid value and has solid fundamentals in my opinion. I'm not buying right now, and I want to share why, because my strategy as a dividend stock investor is really centered these days around core stocks, because there are core stocks, really world-class, huge companies that are on sale right now. And so I want to get into that in the video as well. Get ready, everyone, for a really exciting dividend stock investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So this video will be broken into 2 segments. For those of you that want to skip around, check out the timestamps in the description below. I always take time to create very detailed timestamps to save all of you at home time. Let's get started. As you can see on the screen in front of you right now, I want to cover some basic information about Viatris. Viatris was a spin-off from Pfizer. They combined with a company called Mylan, the Upjohn unit from Pfizer, and this is a company that is largely focused on generic prescription drugs and biosimilars, although they're going to be selling that division. I want to talk about that in a minute. The price per share now is $10.20. You can see in the stock chart here that it has fallen off of a cliff. Although, to be fair to Viatris, most companies have done this recently. Our market has been choppy. There are a lot of unfortunate global events happening right now, and my heart goes out to anyone affected by the terrible global events that we're all witnessing right now. The 52-week high for Viatris was $16.29, and so it's down 37% from the high. Based on the analyst estimates for 2022 and 2023, you can see here that the forward PE is just below 3. Let me repeat that. This is a company right now that is trading at a forward PE, price earnings ratio, below 3. Most of the companies that I invest in have PEs somewhere, say, between 15 and 22 when I'm buying that particular stock. Sometimes a little less, sometimes a little bit more, but usually in that range. 3 is a lot different than a PE of 15 or 20 or even 25 for that matter. I want to share with you why the PE is so low as we progress throughout the video today. But the first insight that you'll see on the screen in front of you right now is the fact that they're not really growing. This is a company that I look more as an annuity model in some ways. I'm going to get to that philosophy in the video today. This is a company where I do not expect much growth. That being said, even on a company that's not growing, I think a PE this low says that it is undervalued. Let's keep going. The dividend per quarter is 12 cents. In fact, they just increased it recently from 11 cents to 12 cents, or a 9.1% dividend increase, which is not bad for their first increase as a standalone company. The dividend yield starting right now is 4.7%, which is very compelling in this market, especially when you put on top of that a growth rate. And they have room to grow the dividend because the payout ratio is an extremely healthy 13.8%. Market capitalization is 12 billion. As we go through these numbers, what is there not to love about these numbers? It's like, yeah, the company is not growing very much, but boy, payout ratio is low, PE ratio is low, dividend yield is high, dividend growth rate is high. There is a lot to love about Viatris here, but I want to explain some things as we go through the next few slides as to how analysts are interpreting this company and how I look at the company as well. So let's keep going. As you can see on the screen in front of you right now, one of the things that happened recently is Viatris announced some news. And as part of their recent earnings report, they said, hey, we're going to sell our biosimilars business. And I want to get into this in a minute, but out of their portfolio of businesses, biosimilars, it's a smaller sliver of what they do. In fact, the biosimilars business as a percentage of revenue at Viatris is only about 7.5% of the company's revenue, but it's the one business segment that is growing, whereas the rest of Viatris, it's slowly shrinking. And so I think when they decided, hey, we're going to sell this biosimilars business over to Biocon Biologics, Wall Street really did not react to that very well, and the stock started tanking as a result of that. But when I actually read the data behind this sale, I like what I see. They're going to basically be raising up to $3.335 billion on this sale. $2 billion is going to be upfront cash that they can use to pay down debt. One of the things I like about Viatris is already they've been paying down a lot of debt, and they have to because they were left with a lot of debt during the spinoff from Pfizer. They're also going to have $1 billion of convertible preferred equity, representing a stake of at least 12.9% in Biocon. And so, two things there. Preferred equity is oftentimes a really good deal because typically the way that a preferred shares will work is they'll have a different kind of dividend distribution related to them than the average common ordinary shareholders. And so that's something to keep in mind. Warren Buffett is famous for striking very sweet deals on preferred equity and scoring really special deals for himself that way. And it seems like Viatris, with this whole Biocon thing, with selling off their biosimilars to Biocon, at least they're going to have up to 12.9% of the company, and it's going to be on a preferred basis. So it's probably a sweet deal for Viatris. And I think a lot of people were thinking, hey, Viatris is getting out of biosimilars. Well, they are in some ways, but they're still going to have exposure because they're going to own 12.9% of the new company. And so that's something I think a lot of investors missed. Let's keep going. As you can see on the screen in front of you right now, they are going to have nearly 2/3 in immediate cash proceeds, as I just mentioned. There's something really interesting on here. It enhances their margin profile, it reduces complexity, it frees up R&D capital, so on and so forth. But what I thought was really interesting was all the way at the bottom. It seems like they're expecting to unlock additional value. They've identified other assets that they own, and they might be able to sell another $6 billion of assets by the end of 2023. And so I wonder almost if this Biocon thing wasn't what sent the stock down as much as it is the uncertainty of, wow, you're selling $3 billion. Where's this other $6 billion coming from? What are you doing, Viatris? What are you selling off? And so it may be the uncertainty around that $6 billion that is leaving Wall Street a little confused. Now, one thing that's not on the screen now, but I want to mention to all of you is Viatris is getting a pretty darn good price on this particular asset. So the biosimilars business they're selling to Biocon, they're selling it at a 16.5x adjusted EBITDA. Now, I pulled the adjusted EBITDA for the company for the last year, and it was $1.4158 billion. I know their market cap is $12.37 billion. And so if I take the current market cap, I divide by adjusted EBITDA, the company is currently trading at an 8.74 times adjusted EBITDA, but they're selling it at 16.5 times adjusted EBITDA. And so the point I'm trying to make here is I think that Viatris got a good deal for their biosimilars business. And so they're selling it into a strong market. They're still going to have some exposure to that biosimilars business through their stake in Biocon, but they are going to pocket $2 billion, which they can immediately use to pay down debt. I actually like what I see here. Let's keep going. As you can see on the next screen, they proceed to go through some of their operational numbers. And I want to share some operational numbers. This is from the year ended December 31st, 2021. And so you can see here, and it shows the 3 months ended December 31st as well, and it compares to the prior year, although some of these comparisons are difficult in the sense that Viatris is kind of a newish entity, and it's going to take a few years before there's really a solid baseline. But you can see here, obviously, revenue is growing, but again, it's weird comps, and so that's what you want to keep in mind, is that it's not always easy to kind of compare a new company like this year over year, especially when there was a preceding company, Mylan, didn't include Upjohn, which is part of Viatris right now. The key thing, though, on this screen that I want to share with all of you that I think a lot of people get wrong about Viatris is that the loss from operations is a loss. It's just that. They are losing money. You can see loss from operations. And you can see for the year ended, they lost $34 million in 2021. But if you go even further down, you see net loss. Net loss is $1.269 billion for 2021. So the company is quote unquote losing money. Now I'm going to show you a different screen in a minute that adjusts the EPS, because this EPS here, the GAAP EPS, is a little misleading. They're not actually losing money according to their adjusted EPS. And a lot of these losses here appear to be amortization related to the restructuring of the company. Now, something else I want to point out on this screen, there's really two reasons I brought up this screen. One was to show you that a lot of people believe it's losing money, but it's not really losing money. The other thing that I want to show you is how much it's costing them to service debt. You can see here interest expense. There's a line item called interest expense. That's a blue line right under loss from operations. You can see on the third column over, year ended 2021, it's costing them about $636 million to service their debt stack on any given year. Now keep in mind, keep this number in mind, maybe write it down, because in a minute I want to show you their adjusted EPS calculations that puts into perspective that debt service, it's not that bad. And as a percentage of what they're doing. That being said, the company thinks it's bad, so they're going to continue to use proceeds from cash flow. They're going to continue to use proceeds from sales like the biosimilars business to pay down debt, so the debt service is even more manageable than it is now. But I want to get into their adjusted numbers as you dig through the earnings, because the adjusted numbers actually show a different story, and it shows that the debt they have is manageable. As you can see on the screen in front of you right now, check it out. This is their adjusted, and you can see it's a reconciliation of non-GAAP financial measures. It's unaudited, it's not GAAP, but you can see here this, remember I said $1.269 billion? That's all the way in the third column at the top. That's the US GAAP net loss. They're losing money. But here you see purchase accounting related amortization, primarily included in cost of sales. So there's some crazy accounting stuff going on here. I imagine this is related just to the company being completely restructured. There was a reverse Morris Trust spinoff of Upjohn, and it combined with Mylan. If you actually look at that $4 billion line item there for the year ended 2021, that is added back onto that loss, it turns them positive. If we go all the way to the bottom of this, the adjusted net earnings, this company actually earned $4.467.8 billion in 2021. And so they're earning good money. Now, remember that debt servicing number we just looked at. The debt servicing for this particular company on any given year is $636 million. It's going to go down because they're paying down debt. $636 million is a understandable amount as compared to $4.467 billion adjusted net earnings. And so I'm not so concerned about the debt as a lot of other people are, but I think the reason people are concerned and the company is concerned, quite frankly, is because the interest rates are probably going to go up over time, especially now with tragic, unfortunate global events and the cost of oil going up. Energy costs are going up. In my opinion, that's going to trickle into a lot of industries and a lot of products, a lot of companies. I think we are in for some pretty big inflation here, and I think it's going to affect portfolios. I think it's going to affect companies. I think it's going to affect a lot of things. Interest rates, for example. If inflation gets too hot, the government, the Federal Reserve, will have to increase interest rates, and as a result of doing so, cost of servicing debt for companies like Viatris and others could be more expensive. So I think that's why there's a rush at Viatris to pay down some of their debt. I want to keep going. Let's check out another thing. Check it out on the screen right now. I want to show you the balance sheet. Balance sheet here for Viatris just gives another sense of how they're looking. You can see in particular, there's a lot of goodwill and intangible assets. I would say what I like seeing is just current assets. If we look at current assets, they got 10.9 billion. Now, intangible assets, goodwill, I don't know if I bank too much on those. For those that don't know, goodwill is actually the difference between the book value and the purchase price of an acquisition. If a company overpays beyond book value for an acquisition, that's what that means. And so under liabilities, you can see they have 19 billion in long-term debt. Now that is a lot. That is a lot of long-term debt, especially for a company of this size. We can see that the debt stack is manageable, but the raw dollars of debt are large. But the main reason I want to show this screen is they're making progress year over year of paying down that debt. It's now 19.7 billion instead of 22.4 billion just a year prior. And it seems like from their asset sales, they're going to pay down more debt. And from cash flow from operations, they're going to continue to pay down more debt. I think, personally speaking, that Viatris is on a good path. And so I want to take a step back here. I want to share a summary of what I just discussed, and then I want to get into some personal thoughts about Viatris and get into my portfolio strategy. By the way, if you're enjoying the video so far, please go ahead and smash the like button. It really means the world to me. It helps me out. I'm working so hard to bring these videos forth on YouTube. It's been a little bit difficult in the middle of a lot that's going on in my life. My family, we're moving right now, and in the midst of the move, there's a lot to do, and so thank you for bearing with me. Also, don't forget to subscribe. Whereas my videos have been coming out a little less frequently lately, if you subscribe, it will encourage me to make more videos, and you'll always be notified when a new video comes live. On that topic, I also have a Patreon. I'm going to link to it in the pinned comment below. Check that out for more videos and bonus content, and also for my stock trades. At the corner patron tier, I have new videos all the time. At the backyard tier, I share trades. And there's a bunch of other content there on Patreon as well if you're looking for more content from PPC Ian. All right, everyone, as you can see on the screen in front of you right now, the next thing is just, let's summarize this. It's trading at an adjusted PE of 2.93. They're selling their biosimilars business to Biocon. They're selling it at a 16.5 times adjusted EBITDA, whereas the company overall is trading at an 8.74 adjusted EBITDA. Biosimilars is only 7.5% of the company revenue, but it is one of the only categories that is actually exhibiting growth. On a GAAP basis, they're losing money. On an adjusted basis, they earned 4.47 billion. Interest expense is a manageable 636 million a year based on their earnings, their adjusted earnings, that is. Long-term debt is high at 19.7 billion, but it's coming down. I look at Viatris like a land lease deal with an expiration date or an oil trust with finite resources. Let me get into this. This is really important. How do I look at Viatris right now? Viatris, especially now that they're choosing to sell off the one portion of their business that is growing, I look at it kind of like an annuity that when kind of your time is up, it's gone. Let me explain to you what an annuity is for those that don't know. An annuity is a product you or I could purchase from an insurance company, a life insurance company. It's typically a product where you can put money into it, the money grows, but when you reach a retirement date, you can click if you want to annuitize it. You don't have to annuitize it. You could pass it on to future generations without annuitizing it. But if you choose to annuitize an annuity, what will happen is from that point forth, for the rest of your life, it will pay you income, cash flow, monthly. The problem with an annuity as compared to dividend stocks is when you pass, all of it is gone. It's just at that point, it's gone. It's not passed on to future generations. The benefit of a dividend company is it could be taxed at the time of passing, depending on someone's net worth and depending on tax laws and where someone lives, so on and so forth. But the underlying principle, it can be passed on forever. Now, I look at Viatris kind of like an annuity because it is trading cheap. It pays out good cash flow. It's a cash cow, if you will. It's trading for nothing. But I think Wall Street is realizing with this company that it will not grow. In fact, it will probably steadily decline over time. And so let's say over 30 years or something, it just keeps shrinking, shrinking, shrinking. So someone analyzing and placing capital in this kind of company would have to analyze, is the 2.9 PE a good price to pay for a company that is going to pay me a ton of dividends and cash flow, but is slowly shrinking over time? This is a lot different than analyzing a company like the Home Depot, which is a company that I just bought more shares of yesterday. I shared that with my patrons, that is growing over time. These are the types of trade-offs that dividend investors need to think about. I can't make the answer for anyone other than myself, but for me, that's how I look at it. Let me give you another parallel. There are people in real estate that will invest in land lease properties. Some of these land lease properties are actually sometimes even under a freeway. It's industrial land or storage facilities or warehouse facilities that might be on Caltrans or on government land, if you will. Sometimes the terms of those deals is like, hey, you can build your structure, you can run your business here, but your land lease is only, say, for 50 years or 30 years. At the end of that time, your business is gone. So the types of calculations that those types of investors make is very different than the types of calculations a Home Depot investor makes. When you know that there's a finite lifespan of an investment, it's going to trade at a much lower PE. You're going to look to get as much cash out of it as possible, and you're going to plan for it to shrink and maybe even eventually be gone over the long run. Now, I look at Viatris as not going away. It's kind of like an annuity that's always shrinking, but it never quite goes away, unlike a land lease that terminates. Or an annuity, a life insurance product that terminates, but that's how I look at it. I want to give another example. Some of you are familiar with the oil industry. There are publicly traded oil energy trusts, and some of these trusts, the way it works again, is they have finite resources. A lot of them are structured as like a master limited partnership, and what happens is they'll pay out a dividend and they'll mine for oil, drill for oil on the land they have. But once all of the oil is extracted, that trust basically is not worth anything at the end of the day. So someone who invests in something like that has a very different calculation and modeling philosophy than someone who invests in an evergreen energy company like Chevron, for example. And so that is not kind of just going away. Or, quite frankly, a company like the Home Depot. And so that's how I look at Viatris. Now, for me, I'm not buying more Viatris here, and it has nothing to do with their business model or their annuity-like parallels. It more has to do with where I'm going as an investor, and I'm headed towards core stocks, and I want to hold myself accountable. I want you to hold me accountable that for the next, say, at least 5 years, I'm all in on core stocks, and I want to talk about that. Check it out on the screen right now. We're entering segment 2 of the video today, and I want to just go through my investment philosophy. Some of you have been following me for a long time. I really appreciate that. Please put a comment below if you've been here since the early backyard days, before I was doing even indoor filming. I was doing it in the backyard. I appreciate that. I want to share some realizations that I've had. And what I would say, one realization, is buying few or no dividend stocks in a given year, it's okay to save money for future buying opportunities. That doesn't make a lot of sense for someone who wants an interesting YouTube channel, however. Let me talk to you all. Last year, I bought Viatris. I bought a bunch of other ancillary positions. I got caught up in ancillary, and I'm happy I did. I'm grateful for it. I'm not selling them. They're good positions. But in some ways, would I have been better if I just saved my money last year? Maybe I put it in something like XYLD or stable coins. On the topic of stable coins, check out my pinned comment to check out my crypto channel. I talk about stable coins over there quite a bit. Would I have been better if I just did that last year? And now when core stocks are cheap, like the Home Depot, I just had all this money saved that I could deploy. Well, I think for some people that is better. I don't think I have the patience for that, quite frankly, unless I'm always deploying money in the market. I'm just not happy. But I would also say I have a YouTube channel. And so to have a YouTube channel, it's always good to have stocks I'm buying to stay engaged. And so that's just realization one. Now, am I saying, even with this realization I have now, would I have done anything differently last year? Probably not, but going forward, I'm thinking about it. Let's keep going. As you can see on the screen right now in front of you, the next realization I had was diversification is really important, especially by industry. We're seeing that lately. Oil stocks are serving as a good hedge against this decreasing stock market and these inflationary pressures. Over the past few years, though, especially on two large occasions, I placed a lot of emphasis on ancillary positions when the overall market was expensive. And so what I'm trying to say is just because core stocks are expensive doesn't mean ancillary positions are not. And also, during times when core stocks are expensive, would it be better to wait? And is kind of jumping into too much diversification diversification? And so that's what I've been thinking about a lot recently. And in particular, going forward in perpetuity, I am mostly focused on core stocks with net new capital at this time. I see core stocks being cheap right now. So my patrons already know this. I share all my trades there, but I'm going all in. I'm sharing trades there all the time. I've been going very aggressively, and I'll continue to on Johnson & Johnson, the Home Depot, 3M, and others. Right now, ancillary stocks are also cheap. Viatris is cheap, UTS is cheap, others are cheap. I am not buying these companies now because I prefer to invest in core stocks. I believe with the complexity of the world that we're in right now, smaller companies are going to have a difficult time. This is a winner-takes-all society if there's ever been one, unfortunately. It is a tricky time to be a citizen of this world. It is a tricky time to be a business. I've come to the realization that going forward, I'm all about core stocks. It may be that this channel is not as exciting as it once was because I'm not going to be covering ancillary positions as much. It may be that what I'm doing is more boring for myself. But what I have found as I get older is there is less time, and I've found this with this move. There's been nothing like this move that has underscored to me the scarcity of time. And so I want to get into that. Let's keep going. As you can see on the screen in front of you right now, moving puts life into perspective. From start to finish, quite frankly, this move is going to consume an entire year of time. It's one of the biggest projects we've ever taken on, if not the biggest. And time is precious. There is something to be said about keeping it simple. The best part of dividend investing is the simplicity of core stocks. I can buy the Home Depot. I don't really need to analyze it ever again. I know I can set it and forget it. And so what I am saying is my portfolio direction will evolve here. Yes, I love Viatris. I will continue to hold it. It's a great screaming value for the right type of investor who wants that annuity model stock. There's going to be a lot of cash flow extracted from that if they can keep increasing the dividend. Yes, I think other companies like UTS Brands Inc. are great values right now, or at least reasonable values. But for me, I have a revised list of top 10 stocks that I just shared on my Patreon. It only comprises 39.6% of my portfolio. I don't sell stocks, so for me to get that 39.6% to 60 or even 70% of my portfolio, I need to stay focused. And so I am not going to change anything I've done in the past. I don't sell, and I really enjoy the companies that I own, and I think they're good selections. But going forward, I'm going to be pretty boring here, and I encourage folks in the community just to hold me accountable to that, because that's what I have to do to get where I want to go, to build a robust portfolio that can withstand the pressures and the turbulence that modern day living entails. Our society as a globe, I've got some concerns about what's happening. And I want a portfolio as best as possible that can weather the storm. So all right, everyone, and of course my heart goes out to everyone all across the world who is facing very difficult situations right now. My heart goes out to the everyday people who are just facing terrible times. And this is a channel that is all about dividend stock investing for the everyday person all around the world. I support everyday people who are looking to better their lives through finance. All right, everyone, before we head out today, I want to do a just quick reminder. Please smash the like button. It means the world to me. Really, truly. And don't forget to subscribe. I can't wait also to see you in the comments below. Please share the video with others if you think it's valuable. And before I leave, in terms of a full disclosure, I do own the stocks mentioned today. I am long Viatris, VTRS, Pfizer, PFE. I am long the Home Depot, HG, Johnson & Johnson, J&J, 3M, MMM. I am long Utz Brands Inc., UTZ. I am long Chevron, ticker CVX. All right, everyone, before I go, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market anywhere else, please consult your licensed financial advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. Also, by the way, in terms of full disclosure, I am long stablecoins and XYLD as well, which is a covered call ETF. I mentioned those earlier. I will see you in the comments below. I hope you all have a great weekend, and I'll see you in the next dividend stock investing video.